Peter Rose, Longwood Currency Trading. It's early February of 2021, and I've been doing quite a bit of financial research, economic analysis research in the last few weeks. Well, probably since just toward the end of last year, because I got caught in a pretty shitty trade, and I was just going back over a lot of what my thoughts and rules were and what happened, why I developed the bias that I had developed in that trade and held it too long. And so I thought I'd do a short video today on using fundamental analysis correctly in Forex trading. This is sort of a preliminary groundwork for the study that I've been doing, and it's all my opinion strictly on that, as any video that I do. But over the course of the last few weeks, I've taken some notes. I'll probably do a blog post that's similar to this, so I'll be reading some of those notes as an outline to keep me on track here, because I don't want to ramble on over all this stuff, because the topic is extensive, and it's a volatile topic too. Do you use fundamental analysis? Do you not use it? Okay, well, the way that I look at it, well, let me state right up front, I don't use fundamental analysis. I don't believe in it. I don't use technical analysis. I don't believe in that. I'm a price action trader, but then again, I'm a day trader. I think technical analysis has its place, as does fundamental analysis. So in that sense, in using it within its place, in which I am of the opinion that that's the place to use it in, of which this video will be a partial representation of that, then I do use technical analysis and fundamental analysis. But my primary process of trading as a day trader is to simplify my life so that I don't have to use technical analysis and I don't have to become encumbered with fundamental analysis. I can simply look at price action, grab 10 pips, and then go have a cup of coffee. So in looking at this topic and in trying to simplify it, fundamental analysis there are two types of fundamentals or fundamental analysis, top issues that you can use in saying that you're using fundamentals. One is news, like a non-farm payroll event or something like that. And the other is long-term economic conditions. You look at those and you can analyze them either from an accounting standpoint or a socioeconomic standpoint, or whatever you want to do. But there's long-term economic conditions. You know, I think both long-term and short-term retail traders have to ignore the news. You just can't trade on the news. And I think one of my failures or issues last year in my trading was looking at that news and saying, that's valid, that should affect the price. And it does, but it doesn't do it until you reach two conditions. One, that the news is correlated and repetitive many times, and that it accumulates to reveal truth and hindsight. And I'm going to repeat that later, because it's part of the other aspect of the long-term economic fundamental conditions that you might encounter. So you've got news, such as the NFP, and you have long-term economic conditions. Those are the two types of fundamentals that you can sort of use and categorize them. And again, because news is just chatter, you know, it may immediately affect the price, but if you look at your charts when you have a non-farm payroll event, for example, fucking thing goes, you know, in a 15-minute chart, you can see like it did the other day. We had a 75 pip 15-minute move, I think it was. And then all of a sudden price settled down and retracts back and is part of the longer term process. Now, sometimes an event like that coincides with a swing point in the market or a reversal trend, but I think those two things are coincidental as opposed to one causes the other. I think news is a category all itself, and the stuff that goes about creating a swing point or a long-term reversal are two totally different things. I think the swing points are created because large institutional traders are done with their particular campaign. They flushed everybody out. They've got their position either established or completed for their client, and they're going to go on to something else, and so you get a swing because of that, or you get a reversal due to economic changes that are really radically changing that cause that long-term reversal to occur. But the news itself is just chatter, as taken for an individual thing. You can't say, oh, I've got a non-farm payroll event, and so therefore blah, something's going to happen. Well, yeah, something's going to happen, but you have no way of knowing what that is. Your probability of correctly analyzing price action during an event such as non-farm payroll is minuscule in comparison to a non-news event. Now, you can have a news event occur, like the planes crashing into the World Trade Center, but those are economic changing events. They're not just news events. You know, XYZ company's chief financial officer was found in the Cayman Islands with $60 million of the company's money, and they're going to go bankrupt. And so that's a news event, or whatever you want to pick it. But they're just intermediate hits against or interim hits against an individual stock or an individual currency. You know, you could say, well, we're going to raise oil prices, and then you get a futures price that will react to that. But once everybody gets used to it, then the price settles down. They go, well, it was only a spike because X, Y, Z, and then the price begins to settle back down again. I mean, if you're watching price action, you see this stuff happening all the time. And so we can say that news may immediately affect price, but if it's just really chatter, then price will revert and resume whatever normal type movement it is that you have. So it's only when, again, repeating what I had said earlier, that when the news is consistent and correlated events that may cause changes to future price action. But they have to be cumulative. Individual correlated and cumulated news events collected together may change things. But during that, when that's happening, as retail traders, we're not usually going to be able to ferret that out. We're not going to be able to put those pieces together. You know, the hedge funds and the large institutional traders have hundreds of PhDs in sociology, psychology, socioeconomics, economics, price theory, all that crap, grinding away on news that they're collecting from a local pub in Lebanon somewhere, and correlating that all together. Retail traders, we can't compete with that. So why bother try to do that? I mean, these events, these news events, may very well be hooked up, and they may change price action next week or 6 months from now or whatever, but we're not going to be able to figure that out. And for us to try to spend our time, my opinion, to try to put all those pieces together when we don't have all the pieces is stupid. I mean, it's like a puzzle. You know, you get a bunch of pieces. You get 1,000 pieces for the puzzle, but the picture that you're trying to build, they only give you 25% of the picture. But you get all the pieces, but only 25% of the picture of what it's supposed to look like. How are you going to put that puzzle together? You can't say, well, I'll put all these pieces together. They'll make sense. Well, the ultimate picture may be of a dog, but you are left with 25% of the paw in a thing of snow, and you think it's a polar bear or something. I mean, I don't know what you're going to get out of that, but I think the danger in study for the retail trader is in studying this stuff and trying to put these pieces together, living with all the biases that we have. You know, if you look at the political situation, and I'm not politically oriented, I hate politics, but if you look at events in the economy that are occurring, and you have a Republican looking at those events and you have a Democrat looking at those events, then what happens is the viewpoint as to what's going to happen to change the politics, I guess, at any given point or any given time is going to be totally different, because the Democrats are viewing it through a different lens than the Republican would be. Not saying that either one is going to end up being right or wrong, because both parties are trying to benefit the country to the best of their ability. They just have a different slant to it. One may say quantitative easing, for example, is a good thing, and the other will say, no, it's a bad thing. And they have their reasons to back that up. And regardless of what happens, it'll be okay. Because politics is like ocean waves. Over the long run, you have a mean or median wave height, and you have a median level of political result, and it's all okay. It's just living. You do have wave events as well as political events that are anomalies that shake shit up. I mean, 1 in 457,000 waves is 4 times the mean. You know, you might want to know that if you're a sailor. But I don't think that, I think that we recognize that in our everyday lives, right? So that the news itself, in hindsight, you'll say, oh yeah, this happened, and this happened, and this happened, and this happened, and so therefore, this was the result of that. You know, it's like looking at a pool table, and the guy looking at taking the shot is saying, well, if I hit the ball here and it hits this, and then it's going to hit that, and then it's going to hit this, and then it's going to hit that. Well, yeah, you can have that bias to that, but if that ball is just a little bit off, you get a whole different series of corresponding ball moves as a result of that. So you can become very biased in the way that you read that news, which is what happened to me, and interpret an overall bias for the economic condition that the news is ultimately going to prove you were wrong at, because it's taking you in a different direction, because the news changes. You don't know what the future is. So if you take that one individual news event, and then you hook it up to the next individual news event, and then the next one, and then you say, oh, because of these 3 things, this is going to happen a month from now. Well, maybe, but you've got a month to react to that. If you're a short-term trader, and you go boom to boom to boom, and so this should happen, but it's not going to happen for a week or a month or a year, and you trade based on that, you're going to get screwed. We don't have the tools as short-term traders, or even as retail traders, to be able to correlate that news. So the short-term trader may use a news event to determine what's going to happen in the next few minutes. But I think there's an anomaly there because, again, a short-term news event like a non-farm payroll or a reaction to a flood that just hit the cornfields and has wiped them out. The trader, I mean, how many people have heard that news before you get it as a trader? You know, you'd have to listen to all of the news sources and everything it would just be a horrible clusterfuck of information in order for you to pick out that one thing and then pick the trading vehicle out to trade to go by it. That's what professionals do. You're not going to be able to compete with that. And as a short-term trader, if you try to do that, you're going to get it wrong. 99% of the time, you're going to get it wrong. Well, you know, because 90% of the traders lose 90% of their money in 90 days. That's what the fuck everybody's trying to do. They're trying to do what what the investors are doing and what the long-term traders are doing. These guys that come out of hedge funds and are trying to teach trading and are guys that are up there trading long-term and are teaching trading, you can't do that as a retail trader because you don't have the time. I mean, you're working a job or you've got family responsibilities. You're not going off to an office somewhere. I mean, some retail traders that are prop traders, yeah, that's what they do. That's their job. They go off to the office. I'm not talking to them. I'm talking to people like you and me that have jobs, or we were retired, we still have family responsibilities, you still got to take the dog for a walk and all the other crap. You're not sitting there for 8 hours a day. Look, if you're retired, do you want to sit there for 8 hours a day and trade? No! I want to be able to trade for an hour, either bag it or lose it, and be done with it. Well, what am I going to do? Read the news and try to analyze what the possibilities for that are? No, I don't think so. So I'm not sure that that fundamental economic news is viable to trade against. Having said that, I think it's important. I think it's necessary. I think it's critical. Let's go up in scale for the long-term retail trader to be aware of the news, so that you can think in terms of the economic conditions that you could potentially be trading into next week or a month later, so that you can get the right bias to your thought process about the markets that you're trading. Remember, we're dealing with two separate countries with two separate political structures and economic thought process and all the rest of the stuff, and all kinds of different needs of their citizens at different times. So you need to be somewhat aware of all that, but it's background for you, so that you can work in harmony with the currency pair that you're trading with. Like pound, if you're trading pound dollar, you're trading with the pound, right? Because that's the quote currency. So you do need that awareness of the fundamental environment, but you don't need to analyze that because you're going to get screwed up. I think it's important for a short-term trader equally to make sure they're not incorrectly relying on current trend analysis bias that is actually contrary to what the economic conditions are dictating. For example, you can get, as I ran into just recently and had a big loss, I talked about that, I failed to take that overall economic conditions in consideration of my trading, and developed a bias for what I thought was happening, because I was doing a counter trend to the major trend. And you can get away with that if the economic conditions are manageable, understandable, and you really understand the correlation between your faded, your faded short-term trend analysis that's contrary to the longer-term trend analysis. So if you don't have a general awareness of what's going on in the two different pair of countries that you're trading, you really shouldn't be trading at all, because you're trading strictly then on technicals, and you really can't do that because it's a backdrop to those technicals. I mean, the technicals don't move the price. The fundamental economic conditions within the country and the way that people see the economic need for currency transfer, that dictates price action. And so if you're not aware of what those underlying economic conditions are, you have no way of judging what the big institutional traders are going to do. And when those institutional traders start to make their changes, you're going to see it down on that 1 minute chart right away. There's going to be an anomaly there. So if you're not aware that there's certain economic conditions out there that could work contrary to the trade bias that you have, then you're going to look at that spike or that change as a reversion to the mean that will continue on later after it gets done with its mean reversion, or it was a trader just unloading a part of his client's order, or whatever temporary thing fits into your bias box of thought process. So you need to be, it's important, it's vital, well, it's critical for the short-term trader to be aware of financial conditions, fundamentals in the two pair countries that they're working at. Primary to my discussion here, the whole purpose of this video is to discuss something that I learned very readily a year ago, and have made it part of my trading rules as far as the fundamentals go. You cannot use fundamental analysis for trade entry. You use fundamental analysis as part of your risk management plan. That's the nuts of this video. So if you didn't make it this far, you missed the whole thing. So if you know somebody who watched this video and and pooped it like at the 5 minute point, you might want to have them go back and look toward the end, because I want to repeat that. Fundamental analysis is used for risk management, not for trade entry. Don't get the two mixed up. Maybe I'll use another video at some point where I might talk about that in a little more detail if there's any interest in doing that. So appreciate those of you who have subscribed to the channel, or if you haven't subscribed, please do. It shows me that you're out there and watching. And for those of you that are just watching and don't want to subscribe, that's fine. But if you know somebody else that's out there that would enjoy the video, let them know. Because I think I've got a unique approach to all this stuff, and not everybody's gonna tune into it. But there's enough of you out there that support me, and I know you're not doing the comments and stuff because you're communicating with me through email, and I value that a lot. because it means you want to have that personal connection with me to discuss things, as opposed to just watching a video and going, well, you know, I'm going to use fundamentals for risk management. I won't use them for trade entry. That doesn't mean anything. You can't make anything work. You have to really do some analysis of the analysis. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.